Normally I don't do that. I mean, in fact, I can't remember when I did it. We just go right into questions and answers. But I really thought that maybe we were giving a little bit the wrong lesson because all the questions would naturally tend toward current events. And so this time I went back actually to 1942 when I bought my first stock as an illustration of all the things that have happened since 1942. We've had 14 presidents, 7 Republicans, 7 Democrats. We've had world wars. We had 9/11. We had the Cuban Missile Crisis. We have all kinds of things. The best single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund.
Warren Buffett made billions by betting on the right moves and still lost fortunes chasing the wrong ones. Every dazzling success rests on a foundation no one celebrates, mistakes that stung, regrets that haunted him, and lessons carved into every decision. For every winning investment, there were missteps that could have shattered his empire. Behind the polished headlines lies a story most never hear the story of a man who turned failure into fuel and setbacks into stepping stones. But how does the world's smartest investor survive billion-dollar failures and come out even stronger? And what if the real secret to Buffett's empire isn't just what he bought, but what he learned when everything went wrong? Stay until the end, because the real story of Warren Buffett is nothing like the one you think you know. Before the billions, there was a boy in Omaha who couldn't stop thinking about money, and not in a greedy way, but like a puzzle he was determined to solve. At 11 years old, Warren Buffett made his first stock purchase, grabbing 3 shares of Citi's Service Preferred. When the stock dipped, he panicked and sold too early, only to watch it rebound. That first sting could have scared him away, but instead, he absorbed a lesson about patience and emotional control that most adults never master. By 13, he was filing tax returns, delivering newspapers, and running a pinball machine business, placing machines in local barbershops and splitting profits. Every dollar he earned wasn't just saved, it was reinvested, compounding his wealth quietly, while others spent theirs on fleeting pleasures. Buffett didn't fall in love with making money. He fell in love with the challenge of growing it smartly, treating every small opportunity like a seed with the potential to grow into something extraordinary. It was a mindset built early, and it would shape every decision he made for decades to come. In the 1960s, Buffett spotted a struggling textile company called Berkshire Hathaway. To most, it was a dying business on its last legs, riddled with problems no smart investor would touch. To Buffett, it was a golden opportunity hiding under layers of dust. He bought control of the company after a drawn-out battle, but soon realized the brutal truth. The textile industry had no real future in America. Labor costs were too high, competition was fierce, and no amount of brilliant management could save it from collapse. Instead of stubbornly trying to revive a sinking ship, Buffett made one of his smartest moves. He pivoted. He used Berkshire Hathaway as a foundation to build an entirely new empire, starting by acquiring insurance companies like Geico. Insurance offered him something rare: float, essentially free money collected through premiums that he could invest while waiting to pay out claims. Over time, Berkshire stopped being a relic of the past and became the perfect investment machine, a vehicle for long-term value creation. Buffett wasn't just good at spotting undervalued assets, he was ruthless about cutting emotional ties to bad businesses and moving capital to places where it could actually grow. Warren Buffett didn't chase trends, and he didn't get seduced by hype. While others jumped on the next hot stock or tech boom, Buffett stuck to what he knew: find companies with real strength, strong brands, loyal customers, durable business models, and buy them when everyone else ignored them. Coca-Cola was a perfect example. When Buffett bought heavily into it, critics mocked him for investing so much in a sugary beverage company, calling it outdated and risky. But Buffett saw something deeper: an unshakable brand people loved, distributed across every corner of the world, with pricing power that could survive any recession. He wasn't just betting on soda, he was betting on the emotions tied to it, the habits formed around it, and the legacy it carried. Over time, his investment didn't just pay off, it became a cornerstone of Berkshire's massive profits, delivering reliable dividends year after year. Buffett's magic wasn't in buying what was popular or exciting. It was in buying what was valuable and waiting longer than anyone else to be proven right, even when everyone else thought he was wrong. When Buffett acquired See's Candies in 1972 for $25 million, it wasn't an obvious slam dunk by traditional valuation metrics. The numbers alone didn't scream great deal, and plenty of other investors would have passed. But See's taught him an even bigger lesson, one that would change his entire investment approach forever. See's wasn't just selling chocolate, it was selling memories, nostalgia, and a sense of tradition that customers trusted and cherished. Every holiday, every celebration, every special occasion tied into those simple white boxes of candy. Its customers would pay more each year without hesitation because they weren't just buying sweets, they were buying experiences and emotions. Unlike manufacturing-heavy businesses that devoured capital, See's didn't need constant reinvestment to thrive and grow. It quietly printed cash with minimal effort. This showed Buffett that a strong brand could be more powerful, more defensible, and more profitable than any physical asset ever could. The See's deal didn't just boost Berkshire's profits, it reshaped Buffett's philosophy on what true value looks like and taught him to never underestimate the invisible strength of customer loyalty. Even the Oracle of Omaha wasn't immune to painful mistakes. In 1993, Buffett purchased Dexter Shoe Company, convinced that it had a durable competitive edge and a brand that could stand the test of time. On paper, it looked like a smart, strategic move, an all-American shoe company with a loyal customer base. But the real error wasn't just in overestimating Dexter's staying power against rising foreign competition. It was in how Buffett structured the deal. Instead of paying cash, he used Berkshire Hathaway stock that, had he held onto it, would have ballooned into a fortune over the decades. When cheaper imports flooded the market, Dexter couldn't compete. The once promising company collapsed, rendering the acquisition almost worthless. Buffett later reflected on the deal with brutal honesty, calling it his most gruesome mistake, and estimating the cost at around $14 billion. It was a harsh reminder that even the sharpest minds can let optimism cloud their judgment, and that every share of Berkshire stock should be treated like a precious, irreplaceable asset. For Buffett, it wasn't just a financial loss. It was a permanent scar that reshaped how he evaluated future acquisitions. Airlines seemed like a natural investment during periods of booming travel, and Buffett fell into that trap. He put money into U.S. Air in the late 1980s, believing in the growth of the airline industry. But airlines are notoriously bad businesses. Massive fixed costs, volatile demand, brutal competition, and constant regulatory headaches. Buffett almost lost his entire investment, and even when he later bought stakes in major airlines again, he admitted it was a risky move. His experience in the airline sector taught him to avoid businesses where the economics are fundamentally stacked against you, no matter how attractive they might look during a boom. Oil prices were soaring, and Buffett thought investing in ConocoPhillips was a smart play. But what goes up often comes down faster than anyone expects. Oil prices collapsed, and so did the value of Berkshire's massive stake in the company. The same miscalculation happened with Paramount Global, where the shifting sands of the media landscape made predicting success almost impossible. These weren't total disasters, but they were sobering lessons. Industries tied heavily to unpredictable external forces, whether commodities or technology shifts, can humble even the most brilliant investors. While critics accused Buffett of sitting on too much cash, he saw it differently. Berkshire Hathaway now holds over $334 billion in reserves, a staggering war chest waiting for the right moment. Buffett's philosophy is simple. In a world fueled by fear and greed, patience is the ultimate competitive advantage. When markets crash and others panic, Buffett will be ready to swoop in and buy great companies at a discount. Keeping cash isn't laziness, it's strategic firepower, and it shows that sometimes the smartest move isn't action, it's waiting for the perfect opportunity to act. Despite building one of the greatest fortunes in history, Buffett never saw money as the ultimate goal. Over the years, he's pledged to give away more than 99% of his wealth. In 2024 alone, he donated more than $700 million to the Susan Thompson Buffett Foundation. supporting causes ranging from education to healthcare. His giving pledge, created alongside Bill Gates, invites billionaires worldwide to commit to giving away the majority of their fortunes. For Buffett, true legacy isn't measured by how much you keep, it's measured by how much you leave behind to make the world better. Warren Buffett's life is a masterclass in embracing both triumph and failure. He didn't get everything right. He lost billions through misjudged investments and miscalculations. But what sets him apart isn't perfection, it's resilience, self-awareness, and a relentless commitment to learning. His fortune wasn't just built through genius, it was built through humility, patience, and the understanding that even legends have scars. If Buffett's journey taught you something new about success and mistakes, make sure to smash that like button, leave a comment sharing your favorite Buffett lesson, and subscribe to the channel. And don't forget to hit the bell icon because the next story could be the one that changes everything for you.